Welcome to our deep dive into internal rate of return, or IRR. Today, we're going to meticulously explore this vital financial metric, covering examples, answering common questions, and providing detailed data analysis. So, buckle up. First, let's define what internal rate of return is. The IRR is the discount rate that makes the net present value, NPV, of cash flows from an investment equal to zero. It's essentially the break-even rate of return for an investment. To illustrate, imagine you invest $1,000 in a project, and you expect to receive $300 annually for the next 5 years. The IRR is the rate at which the present value of these cash inflows equals the initial investment of $1,000. Why is IRR important? Well, it helps investors and managers compare different investment opportunities. An investment is generally considered good if its IRR exceeds the required rate of return. Here's another example. Suppose your company is considering two projects. Project A requires an initial investment of $2 million and is expected to generate $500,000 annually for the next 10 years. Project B requires an investment of $2,500,000 and is expected to generate $600,000 annually for the next 10 years. Which project should you choose? To solve this, we calculate the IRR for both projects. Let's assume the IRR for Project A comes out to be 14% and for Project B it is 12%. If the required rate of return is 10%, both investments are viable, but Project A is more attractive given its higher IRR. Now, let's address some frequently asked questions about IRR. One common question is, what limitations does IRR have? Firstly, IRR assumes that interim cash flows are reinvested at the same rate as the IRR, which might not always be practical. This assumption can lead to over-optimistic results. Secondly, IRR may not be reliable when comparing projects of different durations. For example, a project with a high IRR over a short period may be less valuable than a project with a lower IRR over a longer period. For more nuanced decisions, consider using the Modified Internal Rate of Return, MIRR, which overcomes some limitations of IRR by assuming reinvestment at the project's cost of capital rather than IRR. Let's perform a case study using Excel to calculate the IRR and MIRR. Consider the following cash flows for a project. Initial investment of $5,000, followed by inflows of $1,500, $2,000, $2,500, and $3,000 in subsequent years. In Excel, we use the IRR function to calculate the internal rate of return. For our example, the IRR comes out to be approximately 20.79%. To compute MIRR, we assume a finance rate of 10% and a reinvestment rate of 8%. Using the MIRR function, we get a MIRR of around 16.27%. This case study highlights why IRR should not be used in isolation. MIRR provides a more realistic picture by adjusting for varying finance and reinvestment rates. Before we conclude, let's summarize what we've learned. IRR is a vital metric for assessing investment opportunities, but it has limitations. Understanding its nuances, as well as alternatives like MIRR, can significantly improve decision-making processes. Thank you for joining us on this comprehensive exploration of internal rate of return. Don't forget to subscribe for more in-depth financial tutorials. If you have questions, drop them in the comments below.